Thank you for joining us on Wealth Plan TV. Today we're talking about debt. We're the second time around on debt. You recall we covered credit cards last time. We're joined by Karen today, who is going to talk to us about home loans. I guess you've all got them. Do you understand them? Welcome, Karen. Thank you for joining us.
Thank you for having me.
Tell us, what is a home loan?
Well, a home loan is basically money that you've borrowed in order to be able to purchase the home.
Okay, cool. That was lovely. Okay, there's lots of different terms that come around home loans. Can we deal with the first one, which is probably the simplest, and that's principal and interest? What exactly does that mean?
What that means is that each month when you make a repayment on the mortgage, some of that repayment actually goes to paying down the balance of the mortgage, although most of it will be interest.
Okay, so the way that the lenders work that is that the amount you pay off the balance pays off the loan in a set time. What typically is that time?
Usually loans now are about 30 years.
Okay.
It can depend a little bit on your age. If you're getting closer to retirement, they like to shorten the term of the loan.
Like I might in another few years.
In a few years.
Okay, so that's principal and interest. So what's interest only?
Interest only is mostly common for investors. There's no principal pay down in each monthly repayment. The advantage is that it improves cash flow because your monthly repayments are less.
Okay, so if somebody is borrowing for an investment, the interest costs are deductible, but repayment of capital or principal on the loan isn't, which is why they split them out mostly.
Correct.
Okay, so interest only loans are basically suitable for investors. Okay, can you tell us what a honeymoon rate is?
Yes, that's when the bank gives you a lower interest rate for the first year or so. Some of the banks will allow you to have 3 years at the cheaper rate, but usually 1 year is the most common. Then after 1 year, it'll go back to their standard variable interest rate.
There's a comparison rate. Can you tell us about a comparison rate and what that actually means?
Yes, comparison rates were introduced so that it's easier to compare a loan that might have a higher interest rate but no ongoing fees with a loan that might have a lower interest rate but a higher application fee and monthly fee and so on. So it's about comparing apples with apples, and we include everything, all the costs associated as well as the interest rate built in. So it's usually a little bit higher than what the advertised rate is.
Okay, now you can see why I asked that question first. I'm back to honeymoon rates now. How does the comparison rate work for a honeymoon loan, then reverting to standard, in comparison to maybe a more competitive loan that lasts longer?
Such as a basic loan?
Yeah.
Okay, well generally a comparison rate on a honeymoon loan is higher, and for that reason we very rarely do them. In years gone by, when they were first introduced, there were no additional fees with the loan, so a lot of people would take their 1 year at a low interest rate and then get out of the loan and go to a different bank. But the banks didn't like that. So they're doing their best these days to prevent people from changing banks so quickly.
So if the honeymoon rate has a higher comparison rate, it means that probably they're best to be avoided.
That's true. Most people would find a loan on a basic rate, which is not quite as cheap in the first year, but much cheaper for the ongoing years after that. They tend to have much better comparison rates.
Okay, just as an aside, when people are determining cash flow at the most stressful part of their life when they're buying a house, I don't think it's actually to their advantage to have a lower start. I think it's better for them to know what they're going to be paying for the next 25 years and adjust to it rather than find themselves in stress a little later.
Agreed. That's how America got in so much trouble 3 years ago.
And non-recourse loans, of course.
Exactly. So people were enjoying their first few years on really cheap repayments, and then when the jump to the higher interest rate came and their repayments doubled, they really struggled, and
Yes.
so many of the loans fell over.
Okay, so work out your cash flow and get a loan to suit is really what we said, isn't it?
Absolutely.
Okay, now there's another couple of terms I'd love to cover. Redraw, what's a redraw?
Redraw is when you've paid additional funds on top of the minimum required each month, and the bank will often allow you to take that back out again. If you wanted to be saving for something within your mortgage, it means you get a lower interest payment or a lower interest charge each month, but you still have access to that money via the redraw process.
Okay, so it's a way of paying down your loan without actually paying down your loan.
Yes,
Okay.
yes. Well, it is paying down the loan, but you have got the ability in most cases to be able to take that extra payment back again if you need it.
Okay. Now, the ultimate redraw loan is a line of credit. Can you tell us what a line of credit loan is?
Line of credit's very much like having a great big credit card. And for anyone who has trouble with a credit card, do not get a line of credit loan. However, they're brilliant for investors. Someone who is perhaps doing some trading on the stock market can be making their trades, and then when they sell again, put the money back in, so the balance fluctuates constantly. They have generally a monthly statement, and the repayment on them is interest only. So the monthly repayment varies depending on how much money has been drawn out during that month.
So very flexible if you have discipline.
Correct.
Yeah. So a line of credit loan is incredibly flexible if you have discipline. If you don't, then probably a principal interest loan that applies a little bit of discipline to you is the better route in your view. Would that be true?
Absolutely. Really, a line of credit loan usually has a slightly higher interest rate, and unless you need the flexibility of being able to put a lot of money into it and then be able to access it very easily, there isn't a lot of point. If it's going to be fully drawn, then you're better off on a different loan with a cheaper interest rate.
Okay, that's really good. Thank you very much for joining us, Karen.
My pleasure.
Your knowledge has been well appreciated and delivered with a lovely smile, which is nice.
Thank you.
Okay, thank you very much, and we'll see you after the break.